There's a wave of headlines claiming Social Security benefits are jumping from $1,976 to $3,559 in January 2026. But that claim is dangerously misleading. Today, we're cutting through the noise to explain what's actually changing, who truly qualifies for higher payments, and why most people misunderstand these numbers. This isn't about gimmicks or false promises. It's about understanding the rules that determine your benefit and making informed decisions that can impact your retirement for decades. Claims that Social Security benefits will universally rise from $1,276 to $3,259 in January 2026 fundamentally misunderstand how the program operates. These two figures do not represent a before and after increase applied across the system. Instead, they reflect distinct benefit outcomes tied to different earnings histories and claiming decisions. Social Security does not adjust benefits by selecting a new dollar amount for all recipients. Every benefit is individually calculated, and any comparison between two fixed numbers must account for the personal variables that produce them. The January 2026 update is driven by the annual cost of living adjustment, COLA, which is designed to preserve purchasing power rather than enhance benefits. The COLA is based on changes in the Consumer Price Index for urban wage earners and clerical workers and applies uniformly as a percentage increase to existing benefits. This mechanism ensures that all beneficiaries receive proportional inflation protection. A retiree receiving $1,500 per month and another receiving $3,000 per month both receive the same percentage increase, but the dollar amounts differ because the base benefits differ. There is no flat dollar increase and no targeted benefit tier that doubles payments for certain recipients. The misconception arises when high-end benefit examples are compared directly to average benefit figures. A monthly payment near $3,559 is typically associated with an individual who earned at or near the Social Security taxable wage base for most of their career and delayed claiming benefits until the maximum age allowed. By contrast, a benefit around $1,776 more closely reflects an average retiree who had moderate lifetime earnings and may have claimed benefits at or before full retirement age. These are not policy changes. They are outcomes produced by the existing formula. Social Security benefits are calculated using a worker's 35 highest earning years, adjusted for wage inflation. If an individual has fewer than 35 years of earnings, 0 earning years are included, reducing the average. This average indexed monthly earnings figure is then applied to a progressive benefit formula that replaces a higher percentage of earnings for lower income workers and a lower percentage for higher income workers. The resulting primary insurance amount is the foundation for all future adjustments, including COLAs. Because the COLA compounds on an individual's existing benefit, disparities in monthly payments naturally widen over time. However, this widening is not evidence of unequal treatment or special increases. It reflects the mathematical reality of percentage-based inflation adjustments applied to benefits that started at different levels. Understanding this distinction is critical for retirement planning. The January 2026 update is not a windfall or policy shift. It is a routine inflation adjustment layered onto benefits that were determined long before by earnings history and claiming strategy. Social Security retirement benefits are fundamentally driven by an individual's lifetime earnings record, making long-term work history the cornerstone of the program's benefit structure. The Social Security Administration calculates benefits using a worker's 35 highest earning years adjusted for national wage growth. These indexed earnings are averaged to produce the worker's average indexed monthly earnings, which serves as the primary input in the benefit formula. Individuals who consistently earned higher wages over a full 35-year career accumulate a higher AME, resulting in a larger baseline benefit than workers with lower or inconsistent earnings. When a worker has fewer than 35 years of covered employment, the calculation does not adjust for missing years by shortening the averaging period. Instead, 0 earning years are inserted into the formula to reach the required 35 years. This significantly lowers the AME and, in turn, the monthly benefit. Career interruptions due to caregiving, health issues, unemployment, or early retirement can therefore have long-lasting consequences on benefit levels. Even modest additional years of earnings later in life can improve outcomes by replacing 0 or low earning years in the calculation, highlighting the value of continued workforce participation when feasible. Once the AIME is established, it is converted into a primary insurance amount through a progressive formula that replaces a higher percentage of earnings for lower income workers and a smaller percentage for higher income earners. While this structure provides a degree of income redistribution, it does not eliminate the strong relationship between lifetime earnings and benefit size. Higher cumulative wages still translate into higher absolute monthly payments, even though the replacement rate declines as income rises. The age at which benefits are claimed introduces the most significant variable an individual can actively control. Claiming before full retirement age triggers a permanent actuarial reduction, reflecting the longer period over which benefits are expected to be paid. For workers born in 1960 or later, claiming at age 62 results in roughly a 30% reduction from the full retirement benefit. This reduction is irrevocable and applies for the entirety of the retiree's life. Delaying benefits beyond full retirement age increases the monthly payment through delayed retirement credits, which accrue at approximately 8% per year until age 70. This adjustment does not merely defer payments, it permanently raises the benefit level, increasing lifetime income for individuals with average or longer than average longevity. The interaction between lifetime earnings, years worked, and claiming age ultimately determines the benefit outcome. While past earnings cannot be changed retroactively, decisions regarding continued employment and the timing of benefit claims remain powerful tools for shaping long-term retirement income. Social Security provides a built-in incentive for delaying retirement benefits beyond full retirement age through the application of delayed retirement credits. For individuals born in 1943 or later, these credits increase monthly benefits by approximately 8% for each full year benefits are deferred after full retirement age up to age 70. This increase is actuarially determined and permanently raises the benefit amount, rather than merely postponing payments. The adjustment reflects the shorter expected payout period and is designed to maintain long-term balance within the system while rewarding later claiming. Because delayed retirement credits compound annually, the cumulative impact is substantial. A worker who delays claiming from full retirement age at 67 until age 70 earns roughly a 24% increase over their full retirement benefit. This elevated benefit becomes the retiree's new base amount and is used for all future cost of living adjustments. As a result, delaying not only increases the initial monthly payment, but also magnifies the dollar value of future inflation adjustments over the course of retirement. The highest Social Security retirement benefits are therefore received by individuals who combine maximum or near maximum lifetime earnings with delayed claiming. Filing early permanently reduces benefits, while delaying increases them, making early claimants structurally unable to reach the top benefit levels regardless of their earnings history. This explains why retirees receiving the largest monthly payments are almost exclusively those who waited until age 70 to file. Earnings history plays an equally critical role. Social Security taxes are assessed only up to the annual taxable wage base, which represents the maximum amount of income subject to payroll taxes in a given year. Workers who earn at or above this threshold consistently over a 35-year career contribute substantially more into the system than average earners. Their higher contributions translate into higher average indexed monthly earnings, which form the foundation of the benefit calculation. While the benefit formula is progressive and replaces a smaller percentage of income for higher earners, it does not cap benefits at average levels. Individuals with sustained high earnings and full participation in the system can qualify for monthly benefits exceeding $3,500, particularly when delayed retirement credits are applied. These outcomes are not special exceptions or policy-driven bonuses. They are the predictable result of long-term earnings at the taxable maximum combined with strategic timing of benefit claims. Understanding this interaction clarifies why maximum benefits are limited to a relatively small group and underscores the importance of both earnings consistency and claiming strategy in determining retirement income. Social Security provides several layers of benefits for married couples, including spousal and survivor benefits, which are structured to ensure financial protection across lifetimes. Spousal benefits are calculated based on the primary worker's full retirement age benefit, not the amount the worker may have received if claiming early. This means that even if the higher earning spouse files for benefits before FRA and accepts a permanent reduction, The spouse claiming a spousal benefit is entitled to receive a payment calculated as a percentage, up to 50%, of the unreduced full retirement age benefit. This distinction prevents early filing by one spouse from penalizing the other, ensuring that the system maintains fairness in family level benefit allocations. The mechanics of spousal benefits are straightforward but often misunderstood. A lower earning spouse can claim either their own benefit or the spousal benefit, whichever is higher, but not both. Timing is critical. Claiming a spousal benefit before full retirement age triggers a reduction in the amount received, proportional to the number of months claimed early. However, waiting until FRA allows the spouse to capture the maximum 50% of the primary worker's unreduced benefit, preserving the intended protective function of the spousal program. Survivor benefits function on a similar principle but are focused on financial continuity after the death of a spouse. The surviving spouse is eligible to receive the higher of the deceased spouse's benefit or their own, rather than being limited to the amount the deceased actually collected. This structure creates a strong incentive for the higher earning spouse to delay claiming until age 70, if feasible. By doing so, the delayed retirement credits not only increase the worker's monthly benefit while alive, but also maximize the survivor benefit for the spouse. For couples with significant longevity, this strategy can result in decades of additional income for the surviving partner. The interaction of spousal and survivor benefits underscores the importance of strategic planning in Social Security. Early claiming may provide short-term income, but it permanently reduces both the individual and the survivor's potential benefits. Conversely, delaying benefits when possible allows both spouses to secure higher lifetime income, leveraging the system's built-in progressive and protective structures. Understanding these rules is essential for married couples seeking to optimize both current cash flow and long-term retirement security, particularly in the context of longevity risk and family financial planning. Social Security imposes specific rules for beneficiaries who continue working before reaching full retirement age. These rules are designed to balance income replacement with the actuarial structure of the system. For individuals who claim benefits early and remain employed, the Social Security Administration applies an earnings test, which sets an annual threshold for permissible earnings without triggering reductions in monthly benefits. For 2026, this threshold is approximately $23,040. Earnings above this limit result in a temporary withholding of benefits calculated at a rate of $1 withheld for every $2 earned above the limit. It is important to note that this reduction is not permanent. Once the beneficiary reaches FRA, the withheld benefits are recalculated and added back, effectively restoring the total monthly benefit that would have been received had the earnings test not applied. The earnings test is a critical consideration for individuals planning partial retirement or phased withdrawal strategies. It can influence the optimal claiming age, particularly for high-income workers who expect to continue substantial employment prior to FRA. By modeling expected earnings relative to the annual threshold, retirees can make informed decisions to avoid unintended temporary reductions and maximize lifetime Social Security income. This mechanism also ensures the system maintains financial balance by preventing early claimants from simultaneously collecting full benefits while earning full wages over extended periods. In addition to the earnings test, taxation of Social Security benefits introduces another layer of complexity for retirees with multiple income sources. Benefits may be subject to federal income tax, depending on combined income, which includes adjusted gross income, tax-exempt interest, and 50% of Social Security benefits. Single filers with combined income exceeding $34,000 and joint filers over $44,000 may be taxed on up to 85% of their Social Security benefits. Strategic management of withdrawals from retirement accounts, such as IRAs or 401ks, can mitigate the tax impact by smoothing income streams, controlling taxable income, and optimizing overall retirement tax efficiency. Understanding these rules is essential for comprehensive retirement planning. Temporary reductions due to the earnings test and potential federal taxation do not diminish the actuarial value of benefits if properly accounted for. But mismanagement can result in short-term cash flow disruptions and higher tax liabilities. Professional planning that integrates earnings, claiming strategy, and withdrawal sequencing can help retirees maximize net Social Security income while minimizing unintended penalties or tax exposure. Social Security was designed as a partial income replacement program intended to provide a financial foundation in retirement rather than a complete substitute for pre retirement earnings. Even for beneficiaries who achieve the maximum monthly benefit, typically through consistent earnings at or above the Social Security taxable wage base for most of their 35 highest earning years, the program replaces only a portion of lifetime income. The progressive benefit formula prioritizes lower earners, offering a higher replacement rate relative to their earnings, while higher earners receive a lower percentage of their total income. As a result, even the highest beneficiaries must rely on personal savings, employer sponsored retirement plans, pensions, and other investments to maintain a standard of living comparable to pre retirement levels. Effective retirement planning begins with an accurate assessment of individual Social Security entitlements, rather than relying on generalized headlines or media speculation. Headlines claiming dramatic benefit increases or exceptional payout scenarios often omit the critical variables that drive actual payments, such as lifetime earnings history, number of years worked, and claiming age. Understanding your average indexed monthly earnings and the corresponding primary insurance amount is essential for projecting realistic benefit levels. Without this foundational knowledge, retirees risk making suboptimal claiming decisions that can permanently reduce lifetime income. Timing is a particularly powerful determinant of outcomes. Claiming benefits prior to full retirement age results in a permanent reduction, whereas delaying benefits accrues delayed retirement credits that increase both monthly payments and survivor benefits. Coupled with spousal, survivor, and potential taxation considerations, timing decisions have a compounding effect on the overall retirement strategy. Using actual figures from the Social Security Administration, accessible through a personal My Social Security account, allows individuals to model multiple claiming scenarios and understand the trade offs between early income and long term benefit maximization. The most effective Social Security strategy is data driven and tailored to personal circumstances, including health status, life expectancy, income needs, and other retirement resources. Relying on generalized claims or sensationalized reporting can lead to early claiming suboptimal benefit levels or unnecessary financial risk. By focusing on one's actual earnings record, accurately projecting benefits, and carefully selecting the timing of claims, retirees can ensure that Social Security serves its intended role as a stable foundation within a broader, diversified retirement plan. Understanding Social Security requires more than looking at headlines. It demands careful review of your earnings record, claiming age, and overall retirement strategy. The January 2026 adjustments are real, but the difference between $976 and $3,459 reflects personal choices and lifetime earnings, not sudden windfalls. Take the time to analyze your own numbers, plan strategically, and make decisions that maximize your benefits for today and for the decades ahead. Social Security is a foundation. How you build on it determines your financial security.